Hey there! In this video, we're going to be going through how you can use the real estate professional status, also known as REPS, to save up to 5 to 6 figures in taxes when investing in long-term and mid-term rental properties. But before we dive into all of that, my name is Thomas Castelli, and I'm a CPA and tax strategist who's helped hundreds of investors reduce their taxes by using the tax code to their advantage. So we have a newsletter in the link to the description to this video with additional tax tips. So go ahead and subscribe to that if you do want to find out more ways you can use real estate and other tax strategies to reduce your tax liability. And also make sure to subscribe to this video because I'm going to be releasing 2 to 3 videos every single week for high income earners, real estate investors, and business owners on how to reduce taxes. So you don't want to miss out on any of those. Subscribe to the channel below. But without further ado, we're going to jump right into the real estate professional status and how you can use it to save up to 5 to 6 figures in taxes. Now, the first thing we have to understand is the passive activity rules, because this kind of sets up why we even need the real estate professional status to begin with. All right. So under the Tax Reform Act of 1986, all rental activities or all rental properties are passive by default. So what does that mean? That means that you cannot take the losses that are largely generated by depreciation from your rental properties and use it to offset the income that you're generating from your job, your business, or the dividends, interest, and capital gains from stocks, bonds, and things like that. That's all in the non-passive bucket, all right? Now, Congress put these laws into place because there's a lot of high-income earners that were buying up rental properties, not doing much work, and simply taking the losses, again, generated by that non-cash expense called depreciation, and using it to save a lot of money in taxes. And they didn't like it. It was very controversial. So they said, you know what, we're going to make all these activities passive, and your passive losses can only offset other passive income and can't offset your active income from your job, your business, so on and so forth. So that's how we got here, right? But then the real estate industry said, wait a second. This isn't fair. This is not fair. Why can a doctor depreciate their x-ray machine and use the depreciation to reduce the income that they're generating from their medical practice? But me, a real estate professional, I work full-time in real estate. This is my bread and butter. This is what I do. Why can I not take the losses from my rental properties and use it to offset the other income I'm generating, just like the doctor? And that's when the real estate professional status was put into place, right? So the real estate professional status came into play in 1994, and it said that if you're working more than 750 hours and it's a big and more than half your total working time in a real property trade or business, then you will be able to take the losses, or you'll have the chance, and we'll get to that in a second, have the chance to take the losses from your rental properties and use it to offset your active income. And again, active income for the purpose of this video is going to be your W-2 job, your business income, your income, dividends, capital gains from stocks, things like that, okay? You can use it to offset your active income. Now, this was intended, as you can kind of see by the way this rule is written, for full-time real estate investors, right? That's the spirit of the law. That's what these rules are kind of built around, right? Now, here's the thing. You could be a real estate professional and still your rentals could still be passive. Here's what I mean, right? So again, 750 hours and more than half your total working time in a real property share or business. There's 11 real property trades or businesses. But for the sake of example here, let's just say that you're a real estate agent or a broker. Real estate agents and brokers are one of those real property trades or businesses. Now you could be working full-time as an agent, spending 750 hours and more than half your total working time putting buyers and sellers of properties together. That's your job. That's what you do. And here's the thing. That qualifies you as a real estate professional, but you need to materially participate in your rental property. So if you're a real estate agent, you qualify as a real estate professional, great. But you have a property manager and you never touch your rental properties, or you just kind of just check in on them every once in a while, then your losses from your rental property still may be passive. Okay. So you need to materially participate in your rental properties. Now, before I get into some of the other things like mistakes and other things you want to know about the strategy, I just want to kind of clear this up here and kind of just finish off this portion of it. And that is to materially participate. There's 7 tests, right? But 3 of them are going to be most relevant to most investors in general. All right. The first one is you're spending more than 500 hours on your rental properties. The second one is that you're doing almost everything yourself. You're doing substantially all. So you're basically you're one person show. You have little to no outside help. The third one is you spend more than 100 hours and no one else spends more time than you. All right. So those are the three material participation tests. So say, for example, you're a real estate agent or broker, you spend more than 750 hours and more than half your total working time. You will need to meet one of those three material participation tests to make your losses non-passive. Okay, on your rental properties. However, if you spent all your time on your rental properties and that's how you became a real estate professional, well, you met the 500-hour test on the way to that 750-hour test, and therefore you are a real estate professional. Great. A few other things here. So when it comes to what is a rental activity, we're talking about long-term rental properties. So just think about your typical 12-month lease as well as mid-term rentals. And this is not to be confused with short-term rentals, right? So you may have heard about the short-term rental loophole. We do have videos here on this channel about the short-term rental loophole, so you can go and check those out. But midterm rentals, even though they're often found on Airbnb and VRBO, they are considered long-term rentals. There's no such thing in the tax code as a midterm rental. You either have a short-term rental that has an average period of customer use of 7 days or less, or 30 days or less when you are providing substantial services, which are hotel-like services, or you have a long-term rental. That's it. That's it. It's either one or the other. So midterm rentals, those properties you're renting out to the traveling nurse or the traveling doctor for 30 to 90 days, those are long-term rentals. So those are the properties we are talking about here. Now, when it comes to qualifying as a real estate professional, if you have a W-2 job, if you're working full-time, chances are you are not going to qualify for the real estate professional status because that more than 750-hour test. And this has been proven and evidenced by many IRS audits and tax court cases. Okay, so and that's because, just to kind of give you a little bit more information here, the IRS considers a full-time job somewhere between 2,000 to 2,080 hours per week per year, which is roughly 40 hours per week. Which means that in order to qualify as a real estate professional, remember, more than half your total working time, you would need to be working 2,081 hours in a real property trade or business. So that would mean you're working 81 hours per week, every week of the year. The IRS knows that's virtually impossible. And that's why almost nobody, and I mean almost nobody, ever qualifies if they have a full-time W-2 job. So how can you qualify if you have a full-time W-2 job or you're working a full-time business? Well, there's the opportunity for your spouse to qualify. If you are married and you file a joint tax return, MFJ for MFJ for all of our tax nerds out there, then you are basically, if one spouse qualifies as a real estate professional, then you both benefit. So it's not uncommon to see we have a couple where one of them is a high income earner, maybe they have a high income job, or maybe they're running a business that they're generating substantial income through, and you have the other spouse who's working part-time or maybe not at all, and they can handle and take over the real estate portfolio, and they're the ones who reach 750 hours and more than half their total working time. Maybe that's the bucket that they fall into. Okay, so that's very common, and that's one way to qualify. All right. Next thing is the way to substantiate this. You do need to actually, if you are ever audited, the IRS will most likely ask for time logs, some form of substantiation that you actually reach the 750 hour and more than half your total working time test. Okay, so you need to have the time log is by far the most credible way to do this. Okay, so you need to have a time log. On that time log, you have the amount of the date of the time you spend on your property, the description of what you did on your property. So, for example, fix the toilet, and the property itself, as well as the amount of time you spent. Okay, so you need to have that time log. You can use an Excel spreadsheet. You can use an app like Toggle or Clockify. There's a bunch of them out there, but you need to substantiate your time. Okay. So let's go ahead and summarize this. I'll do future videos on myths, mistakes, errors, things like that with the real estate professional status. So go ahead and subscribe to the channel so you don't miss them. But to summarize this, all right, all rental activities are passive by default, which means the losses that are generated by depreciation, which is a non-cash expense and only reduces your income on paper and not in reality, right? That those cannot offset your active income, which is your W-2 job, your business, or your stocks, your capital gains, interest, and dividends from stocks and bonds, things like that. They cannot offset. In order to do that, in order to offset it, you need to qualify in order to use the rental losses, you need to qualify as a real estate professional. To qualify as a real estate professional, you spend more than 750 hours and more than half your total working time in a real property trade or business. And you also need to make sure that you materially participate in your rental activities. If all you have is your rental portfolio and that's how you got that 750 hours, great, you're good to go. But if you're working in another real property trader business like an agent or a broker or fixer or flipper or wholesaler, something like that, you do still need to make sure that you meet one of the material participation tests I mentioned earlier in this video. Okay. And midterm rentals and long-term rentals are typically going to be in this bucket here. Okay. And you need to substantiate your time by having a time log. So those are the keys to the real estate professional status. If you do have questions about the real estate professional status, go ahead and drop them in the comments. I'm going to be answering as many comments as I can, as many of them as I can to help everybody out. But if you do want somebody to walk you through exactly what you have to do to qualify as a real estate professional for your situation, or how to use other strategies to help reduce your tax bills, you can request a free consultation with our team by clicking the link in the description to this video. And we'd love to learn more about your situation and how we can help. But that's it for now. So I'll catch you in the next video, and thanks for watching.